This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, in our previous lecture, as you'll be fully aware, we dealt with chargeable lifetime transfers, i.e. those transfers made in lifetime into a trust. And we saw how it was that we compute both the tax, if any, that was chargeable when made, lifetime transfers chargeable when made computation, and we saw the particular issue about how to get that tax figure. That was based on whether or not we referred to the transfer as being a gross transfer or a net transfer. I'm hoping, of course, that by now you know what that difference is, how to recognise that within a question, and how then to deal with it. In terms of what it is and recognising it in a question, you may very well be, and you usually are specifically, told who pays the tax in relation to the CLT. Is it going to be paid by the donor, or is it going to be paid by the trustees of that trust? What we knew then was if it was paid by the donor, it was said to be a net transfer. If it was paid by the trustees, that would be a gross transfer. What happened if it said nothing? Well, because if the trustees are to pay, that required an election to be made by them. If there is no reference in the question to any such election being made, or as to who has indeed paid the tax on the CLT in lifetime, then we assume that the donor paid the tax. Without an election by the trustees for them to make the payment, there's only one other thing that could happen, that would happen: the donor pays the tax. If the donor pays the tax, it's a net transfer. If the trustees pay, as we say, it's a gross transfer. If it's a gross transfer, we apply to the amount of the chargeable transfer in excess of the nil rate band, presuming some part of this transfer, if not its entirety, goes above the available nil rate band. We apply to that excess above the nil rate band the gross rate of 20%. If it is simply a net transfer because the donor has paid, it's no more difficult, except that now we apply a 25% rate to what is a net transfer. It also means that to put the figure into your gross transfer, your cumulative column there that recorded lifetime transfer by lifetime transfer, you need to add together the value of the net transfer and the amount of tax that was payable also by the donor thereon. And that's your gross figure. It's always the gross that goes into that cumulative column. But when we dealt with those examples last time, what we saw was a single CLT being made in lifetime. And although I promised you for this particular lecture, we would be moving on to look at the lifetime exemptions, those exemptions that are deducted from the lifetime transfers of value to bring that transfer of value down to the chargeable transfer figure. It is the chargeable transfer figure that is then included within the IHT computations that we have seen. Whether that is indeed the lifetime transfers chargeable when made, or it is the lifetime transfers chargeable on debt. We've been picking up a chargeable transfer figure to go into those computations. Okay, those calculations, of course, are dependent on knowing what the lifetime exemptions are. Now, as I say, I did promise you those this lecture. It's going to have to hold over to the next lecture, because what I wanted to do is that the next part of this lecture that you're going to see is me taken from a Finance Act 2017 lecture, working through an example whereby we are dealing not just with one CLT, but two CLTs and also a PET, and seeing how this cumulative donor-based tax in the context of both the lifetime computation, lifetime transfers chargeable when made, and then the computation that arises on death, the lifetime transfers chargeable on death. How do we deal with that combination of both two CLTs and a PET? I think that's a necessary and useful exercise for you to do. And the next part of this lecture, therefore, the vast majority of this lecture now, after this introduction, will go through that example with you. Then I promise in the next lecture we'll get to deal with the lifetime exemptions. Enjoy the rest of the lecture. Again, you might want to sort of freeze the screen here and copy down the information for this example. We've got X died on the 1st of January 18. So when a taxpayer died, we're going to have to calculate the amount of tax due on death. What tax will be payable on death? We'll need to do a computation of lifetime transfers chargeable on death, and that will include any pets becoming chargeable for the first and only time as a result of death within 7 years, and then CLTs, again, that have arisen within the 7 years before death, where there may be additional tax to pay. So we're going to deal with those lifetime transfers, pets and CLTs made within the 7 years before death, and compute either the tax to pay or the additional tax to pay. Right. Leaving a chargeable estate of £500,000 to his daughter. Right. Leaving to the daughter. So again, one would anticipate in reality maybe leaving to a spouse, but we're told here X's spouse was independently wealthy, and therefore X bequeathed his entire estate, including a main residence valued at £300,000 to his daughter. Main residence, so that is a hugely important term. And where it's going, we've been told twice now that the chargeable estate of 500, which includes 300 worth of main residence, goes to the daughter. And when you see those ingredients coming together, tax chargeable on the death estate, in that death estate is a main residence left to a direct descendant, what should we now be thinking about? And again, note down in our notes to allow us to answer this question carefully or properly, it's going to be the residence nil rate band. As we have been told here that X's spouse was independently wealthy, therefore X is the first of the spouses to die. X's spouse did not predecease him, therefore there's no unused nil rate bands that would be available here. Again, we're aware that both the nil rate band and the residence nil rate band, get it right, isn't it? If any part of that is unused by the first spouse when they die, then the unused proportion transfers across to the transferee spouse. Not applicable here. X is the first of the spouses to die, so only his nil rate band and residence nil rate band would be available. Right, so we know we've got a death estate worth £500,000. It includes within it a main residence worth £300,000, and there will be a full residence nil rate band of £100,000 available to be taxed at that nil rate of 0%. What a lovely rate that is. So the taxability of the 500, notwithstanding whether any of the normal nil rate band is still available after having first applied it to the lifetime transfers, we'll look at those in one moment's time, but apart from any nil rate band that may remain, there is a residence nil rate band of 100,000. So certainly 100 of the 500,000 estate, 100 of it is definitely destined to be taxed at the residence nil rate band. Okay, what were the chargeable transfers made in lifetime? Right, now we've got there a transfer to the daughter and 2 transfers into a trust for the benefit of his grandchildren. We would be then identifying the type of transfers that these are. The first one, to the daughter, that we would label a pet. And then the transfers to trust for his grandchildren, these are CLTs. So the first thing we do with lifetime transfers when analysing an exam question is to identify, are we dealing with pets, are we dealing with CLTs? The only other type of transfer, of course, would have been an exempt transfer, a transfer to the spouse. We don't have any of those here, but that could be easily dealt with a note. Any transfer to a spouse is exempt. Okay. We're also told that X agreed to pay any IHT due in lifetime on transfers into the trust. So X is the donor agreeing to pay any IHT due in lifetime on transfers into the trust. That therefore means that those transfers are net transfers, and that will equal a 25% lifetime rate on the transfers into trust chargeable when made, i.e. in lifetime, that any excess above the then available nil rate band, that is going to be taxed at 25%. The question, compute the IHT payable as a result of the death of X. Now, this is where we've got to think about this. They're only asking us to compute the IHT payable as a result of the death of X. So that will demand that two computations explicitly here are required. We would need to compute the computation headed lifetime transfers chargeable on death, the PETs and CLTs made within the 7 years of the date of death, lifetime transfers chargeable on death. We'd also explicitly have to compute the chargeable estate and the tax thereon. But to be able to compute the IHT payable on the lifetime transfers that become chargeable on death, if, as we have here, we have any transfers into trusts within the 7 years before the date of death, then it is the additional tax that needs to be computed thereon, because those were chargeable when made. So although the question is only asking us to compute the IHT payable as a result of the death of X, we must implicitly be required to compute any IHT that was paid in lifetime on the CLTs, the transfers into trust. Because if you don't know the lifetime tax, you cannot possibly compute the additional tax due on death. Because as we have seen, both in the previous session and in this session, to get that additional tax due on death, you've got to take away the lifetime tax that was already paid. So, here, to start it off therefore, we need, although not explicitly required, they just want the tax payable on death, we have to set up a computation now headed lifetime transfers chargeable when made. Lifetime transfers chargeable when made. So let's set that up. Lifetime transfers chargeable when made. Now this is only applicable, of course, where we have CLTs. As a standard format, we run 3 columns on here. A little value column to record the amount of the chargeable transfer itself. We then need a column to record the gross transfers and a column to record any IHT. Now in this example, we have got 2 CLTs. We deal with them in order, always in chronological order. Now then, in this example, prior to this first CLT here, there is a PET dated June 13. When dealing with, now see if you remember this from last time, when dealing with CLTs chargeable when made, we only include, for purposes of determining the available nil rate band, we only include on this computation CLTs. We do not include PETs. So although here there is a PET that predates the CLT, the PET in June 13, as we can see there, the first of the CLTs in October 14, that PET will not be deemed to have used any of the nil rate band, because at this point it is not chargeable. That we'll have to revisit, of course, if when we come to compute the tax payable on death, the lifetime transfers chargeable on death, and that then PET becomes chargeable, then it will be using up the nil rate band in that computation prior to the CLT. But at this point, to do this computation, headed lifetime transfers chargeable when made, we include only the CLTs, and only the CLTs are deemed to have used any of the then available nil rate band. So, the first of the CLTs, October 14, and it was 250,000. So, October 14, CLT, and did I say 250? Yep, there we go, 250,000. So 250,000, and it goes to our little working column, the amount of the chargeable transfer. Right, this is the first CLT. There are no other CLTs within the previous 7 years. Therefore, all of the nil rate band is available. It, in October 14, that's the 14-15 tax year, it was, as it still is, 325,000, so all of that 250,000 will be at nil. Therefore, there was no tax to pay. Therefore, the gross figure is 250. Again, though we have read in the question that X agreed to pay any IHT due in lifetime on the lifetime transfers into the trust there, it's irrelevant because that only comes into play when you've exceeded the then available nil rate band. This doesn't, so there is no tax to pay. So on, therefore, to the second and final of the two transfers into trust, March 15, £200,000. So, March 15, CLT, £200,000. Okay, now as we can see, because this is a cumulative donor-based tax, and because prior to this 200,000 transfer in March 15, there had, within the 7 years before the date of this transfer, within the previous 7 years of it, March 15, back there in October 14, we'd had a CLT. So that is deemed to have used 250 of the now available. This is still the 14-15 tax year. It's still, and will continue to be, 325,000 for us there. So it means that of this 200,000, there is only 75,000 of the 325,000 nil rate band still available. We've used 250 there, we now use 75 here at nil. 75 out of 200. That leaves 125,000. Now we go above the nil rate band. Now we need to know who pays the tax. Who is paying the tax? It is the donor, X. Therefore, the net rate is 25%. So 125,000, 25%, just do your calculator there. And I think that comes to, I'll make that, but again, please check, 31,250. It is, as we say, a net transfer. That was the net rate to apply. So the gross figure is the combination of the chargeable transfer of 200 plus the tax thereon, 31,250. So that is 231,250. At that point, your cumulative figure, rolling forward over a 7-year accumulation period, would have gone up to 481,250. So if there had been any more CLTs before the date of death in, was it January 18, then there would be no nil rate band available, and they'd all be chargeable at 25% if, again, X was paying the tax thereon. So there we go, we've got our lifetime transfers chargeable when made, the tax computed. We'd also, but only if required, be able to say when any tax would be payable. Again there, March 15, there was only tax payable on this one of 31,250. What are the rules? The rules are 6 months after the end of the month in which the transfer occurred. That's March 15. 6 months after the end of that month would be the end of September of 2015. That, of course, is after the 30th of April 15, because the 30th of April 15 would be the earliest possible date that any lifetime tax would become payable in relation to lifetime transfers made within the 14-15 tax year. But the 30th of April 15 is clearly earlier, so we will use the normal date 6 months after the end of the month in which the transfer occurred, so that would be due the 30th of September 15. But again, we'd only be putting that in an answer, or only answering that question if it was specifically required of us. Right, Sadly, of course, our hero died within 7 years of having made all of these lifetime transfers. Back to the question, we were told there died on the 1st of January 18. So when we wind our clock back 7 years from 1st of Jan 18 to 1st of January 2011, it picks up all of these lifetime transfers here. So we need another computation, this time headed lifetime transfers, chargeable on death. So let's get that set up, shall we? Lifetime transfers, chargeable on death. Now we knew the date of death, that was January 18. As we said, we'd wind the clock back 7 years and then list out in chronological order those lifetime transfers, going, as we said, in chronological order from the earliest first. We need to record any gross amount of transfer and any IHT due thereon. So what have we got now, therefore? Well, going back to the earliest transfer, that was, let's just remind myself, it was the PET, and I think that was June 13. Yeah, here we go. There it is, the PET there in June 13. So that gets us started on this computation. So it was June 13, it was a PET. How much was the PET? Oh, can't remember my own example. I think it was 175, was it? Yep, £175,000. So, into the computation, lifetime transfers chargeable on death, 175,000. For this computation, use the nil rate band in force at the date of death. Well, it's the same, it hasn't changed as we know for many years. It is 325. That therefore means that all of that 175,000 will be taxed at nil rate, so there is no tax to pay. On to October 14, we then had the CLT. What was the gross amount of that chargeable transfer? You will recall that the first CLT had no tax to pay on it, so the gross and the net are the same, there was no tax to pay, and the figure was 250,000. It's a cumulative donor-based tax, we keep saying. So let's cumulate what has happened over, again we run on a 7-year cycle here, 250 on top of 175, that takes us up to 425,000. Has that 250 therefore taken us above the nil rate band of 325? Of course it has. The nil rate band would go up to 325. We've already used 175 of it, so on this CLT it would therefore mean that the remaining 150,000 of nil rate band would therefore be at nil. Out of the 250,000 transfer, so that leaves 100,000 therefore to be taxed now on death at the death rate of 40%. Not a tricky calculation as long as I've got the right numbers there, so that's going to be £40,000. Right, is that the amount of IHT that would now be payable as a result of the death of the taxpayer? Well, not necessarily, because there's any of two possible deductions that might now apply against that £40,000 tax figure. They are, and it must be dealt with in this order, firstly, taper relief, if available. Now I'm writing in it here because it is available. If it weren't available, you'd say why it was not available. It is only available if the taxpayer did manage to survive for more than 3 years from the date of transfer to the date of death. October 14, therefore, 3 years on would be October 17, taxpayer died January 18, so survive for 3 to 4 years from the date of the transfer, so that is a 20% taper relief level. 20% of 40,000, methinks, is 8,000, and that therefore at this point would leave you with additional tax to pay of 32. Now at this point, well, in fact it's going to be the additional tax to pay, but of course the other deduction, if it were available, would be less any lifetime tax paid. Was there any lifetime tax paid on that? No, there was not. So again, no need to show any deduction. Again, remember, if you're doing as it will be an objective testing question, most like here, then you're just going to do it as quickly and as simply as you can. Your workings are irrelevant so far as the examiner is concerned, but they're very important to you to ensure you come up with the right answer, hence us showing you now. So we've taken out the taper relief. There is no lifetime tax paid, so the additional tax to be paid on death, it would appear, additional tax due on death would be £32,000. That deals with the first of the two CLTs, and on we go to the second. That was March 15 CLT. Now, how much was it? Now, go back here, not to the question, but to your answer. The answer for lifetime transfers chargeable when made. Because we worked out what was a gross transfer on this one of 231,250. 231,250. So that is the figure that now we pick up. So 231,250. Now again, all of this is what's gone on in the 7 years before death. What is our cumulative total so far? 425. So we have used up already the available nil rate band. So it means that all of the 231,250 is taxable at 40%. The whole 231,250 will be taxable at 40%. Again, get your calculator out for 231,250 at 40%, and that looks like it might be, but please do check it, £92,500, methinks. There's no nil rate band. Why? We've already used it up on the cumulative transfers within the 7 years of the date of death that lie before this individual transfer. So 92,500. Right. Two possible deductions we said. Is there any taper relief now? Well, for taper relief to be available, you'd have to survive for 3 years. 3 years on from March 15 would be March 18. Sadly, our hero died in January 18, didn't quite make it, therefore, for the requisite amount of the 3 years, and on that basis, therefore, there is no taper relief. What there is on this one, again, so far as an OT question is concerned, you don't have to put labels in that there's no taper, you just got to get the right answer. So what we are going to do is to simply deduct the lifetime tax paid. Back to your working for the lifetime tax paid. That, methinks, was 31,250. Yeah, there it is. 31,250. And that we can now credit back. 31,250. Take it away to establish, again, the additional tax that is now due on the death of the taxpayer. And that figure, take 31 from 92, 31,250, will be 61,250. £61,250, methinks, there. Okay, now that's the most difficult of the computations, the lifetime transfers chargeable on death, where we have to list out in chronological order PETs and CLTs. Using up the nil rate band that was available at the date of death, that will be 325,000 for you on a first come first served basis. As soon as you go over the nil rate band, any transfers after that, any amounts of a transfer after that, will be chargeable at 40%. If there was a CLT that is now being charged on death, having already been charged in lifetime, then in addition to any taper relief that may be available, then, as we've seen here, any lifetime tax paid would also now be deducted. Okay, take a moment, therefore, just to go back through the example, make sure that we're okay before we proceed. So again, you might want to pause at this particular point in time. Well, next on our list for discussion, of course, is the lifetime exemptions, but As this session has been going a while now, I think what we'll do is to reserve this once again for next time, when I promise you we'll definitely deal with the lifetime exemptions next time. Again, if you haven't already, I'm sure you have, but do have a little read through there. As you can see on the screen in front of you, the list of lifetime exemptions. There's not many of them. We need to know them, and we then need to know how to apply them. And it's that application that we'll go through when we meet again next time. Cheers now.